Please remain on the line. The broadcast is now starting. All attendees.
Hello and welcome to the Morning Bell. I am Keith Harwood. Let's do disclosures and then we'll get into the markets and what we're seeing set up this morning. Options involve substantial risk and are not suitable for all investors. Tradespoon and myself are not investment advisors, not registered with the SEC or FINRA. If you do have questions about your personal financial situation, please consult with a registered financial advisor. Please also note that the information in this presentation is for education and information purposes only and should not be considered trade advice. Myself and or the team at Tradespoon may have a financial interest in the securities presented and the trade ideas, so please keep that in mind as you evaluate these ideas for yourself. As always, if you guys have questions, throw them in the Q&A box and I will address stocks as I see them. Right now, we're in kind of an interesting point for the market. It is a fight through to a new high or get a little bit of pullback and profit taking. You know, we've talked about some of this before. As we go into an election, we often see a consolidation period, but it seems like the market wants to try a new high first. So we'll see if that can follow through. We're really pressing here on SPY in particular. Tech and small caps lagging a little bit, but S&P's looking like they want to make a new high. We'll take a look at that chart and see what we can see from that. Of course, we're also coming into earnings season now. We've got a couple of big ones this week, Delta, Domino's, JP Morgan, Wells Fargo in particular. And we get some more big financials next week. So we got to start watching how financials are handling their first earnings here as they really get us going, of course, with Delta as well. And welcome, Bob. I hope everything is safe down there in Orlando. You know, fingers crossed for everybody down there that this hurricane starts to die down a little bit before hitting land, but I'm not sure what's going to happen. So I just hope everybody's able to stay safe that is impacted by this one. You know, right now, as we look at the markets, probability of success seems to be leaning towards the bull. The bull has a higher probability of success. Of course, there are individual stocks that have more of a bearish setup. We are seeing some massive return on capital that has occurred in a lot of the Chinese stocks, but that is getting hit hard now. So punishing the late buyers into the call options in particular, I can show you a few examples just so you guys can understand how quickly that can start to revert when the sector or the market starts to look toppy with that explosion in implied volatility that we saw. So we'll take a look at a couple of those ideas right now and just sort of get a sense of how that seemingly minimal return over, say, the last week, if you don't factor in the big move up and then pullback, can actually really, really be painful on some of the options positions if not executed correctly. And there are other ways that could have actually turned into a very good thing. For example, an in-the-money debit spread could have turned out very nicely in spite of the pullback. So all in all, it's a lot about trade structure in order to improve that probability of success and maintain some return on capital. Okay. Waiting for 2 to 3 days to confirm a trend change, and today is really another day of minor pullback in the Chinese stocks. So is that trend now over, that explosive parabolic move over? Maybe, and maybe this is another buying opportunity. So we're going to look for that next leg of that move, whether it's going to be back to the highs or if that was overdone and people start to consolidate here and then take some time to determine if we can go higher. There are some shorts out there. I've talked about a few of them over the last few days. I still think UNP looks kind of weak, ConAgra. Some of these names that had poor earnings and poor performance in spite of the market rally. We're starting to see some money pulling out of utilities. Maybe that sector's trend up is finally over. We can take a look at that as well if people are interested. But as always, even in the case of like a JD or pretty much anything China related, selling naked options may have worked pretty well, but God, that was a risky trade. So structuring with defined risk via a spread is often a much better utilization of capital, margin requirements, and helps keep people in the game. So always keep that in mind, is defining that risk as part of the key to options trading in order to keep that account liquid. All right. There's a temptation, I think, right now for the revenge trade in China. So my personal opinion is wait for the charts to tell us when that recovery is going to happen next. So having experienced a lot of those profits, if you got in early, now you start to see a bit of a drawdown in the account or in the trade. Having a trailing stop is a very good mentality. Going back in is a way to turn profits into losses. So going back in too early, or when the market's not telling us that there's an opportunity back to the upside here, can be a very dangerous game. So, sometimes for me, that is a situation where I like to just take the position off, wait 24 hours, and then reevaluate. And I think that can kind of help get me in the right mind frame when I'm looking for more money out of something that's already made some good money, or more money out of something that's lost a little bit of money. I'll take a look at Etsy for you there, Bob, too. We are kind of rounding out here, stalling a little bit in the 10-year yield, just over 4%. I think this makes a lot of sense. We had a big move in the 10-year yield. Getting back over 4% was a hurdle that I didn't actually expect us to achieve so easily. On the way down, I guess, though, 4% didn't really provide much support. It's not providing a ton of resistance, just above 4% is. We're hanging out here, though. There needs to probably be some consolidation as long as the economy is continuing to look fair. The RSI in bonds rarely, in yields, rarely really gets above 70 and stays above 70, or gets below 30 and stays below 30. So we were really approaching this very overbought situation for bond yields. Getting a little bit of consolidation can be healthy for this market before it determines whether we can go up to that 4.2 range, or we go back maybe into this 3.8 to 4 range. Either way, the economy is looking okay off of non-farm payrolls. I think there's going to be a question mark, though, of how big the impact of Milton is on, government aid need and things like that. So that could have an impact on treasury yields as well as on the market on the whole. So, I think it's important to consider, obviously, the reality aspects of it, but we also have to consider for ourselves, if we've got risk on in the market that can be subject to that hurricane and what it can do. We want to be very cognizant of it, because that's a derivative impact of Milton to us. So everybody can be impacted in a different way. Even if you're not in Florida, you can be impacted in the stock market, much like we can all be impacted by tensions in the Middle East, even if we don't live in the Middle East. So stuff to just kind of keep in the back of our mind. I promised I'd take a look at XLU, and I like to look at it here on bar chart because of my trend channels. If and when it decides to load, here we go. So we can see that we're below the trend channel now. This is a testing zone here. We're right below it. We closed just outside the trend channel yesterday. We've kind of flirted with breaking out of the trend channel, breaking down from the trend channel a few times, and usually found support. So if we don't start to find support into utilities here, like today, tomorrow, this may start to look a little bit more like Altria and Philip Morris and some of these other names that had these great looking trends, and then eventually they come to an end. So when that trend channel breaks, it's time to go to the sidelines, or maybe even look at the bearish side of things. So for now, I think utilities are a holdout. I don't want to chase into them. The biggest component of XLU, of course, is NextEra Energy, which I've talked about before. It is bouncing a little bit today, but you can see just how nasty it was 2 days ago in NEE. The trend channel really broke. We got below the 20-day moving average and went straight to the 50. And now we're testing to see if the 50-day can even hold, or if we're going to go to the 100. Very similar, like I mentioned, to what we saw in some of the tobacco names that were a fight to safety. We saw the drop, and then it couldn't ever really catch its footing. Philip Morris was not quite as bad as Altria, but still not great. When these trends are over, we do tend to start to see an attempt to resume the trend, and then a fall. So more like a bear flag kind of setup if you want to look for a bearish side. I would put debit spread, because we'll probably consolidate a little bit into that break. So we break down, consolidate, and then the question is, do we continue lower, or does this start to become a sector that people are interested in again? For now, I lean bearish in Philip Morris and Altria. And so I don't forget about it. We'll pull up Etsy here. Market opening here in about 3 minutes, down small, making a new low today. It doesn't look good on the charts. We're making a new low when the S&P looks like it's ready to make a new high. It looks to me like this is a bearish trade. So I do like the idea that you're talking about here, Bob, of going long-term bearish, just as a general, broadly not great company. Let's look at some of the implied volatility levels to see what we think about that. They've got earnings in 3 weeks. Sorry. Long-term implied volatility, let's go out like 6 months, is pretty stable here, 47.5%. You can see the orange line. So the short-term implied volatility is catching a spike because of the technical setup as well as the earnings coming up. Long-term options don't look particularly overpriced. So getting into a longer-term bearish position doesn't sound too bad here, honestly. June or later. Let's see. I don't have the options market right now because we got 2 minutes to the open, but the June 50 puts yesterday closed out around $9. I don't know how low this can go, but right now the chart says I don't need to look necessarily for support as we look to break down to new lows here, potentially today off of this overall bearish chart formation. So I do tend to agree here as we test these lows, if this doesn't hold, maybe that's the sign of the next big break, or maybe it's the sign of, like a July situation where we got down here 3 months ago and then immediately started the recovery. So watch for that recovery. If we do start to show some relative bullishness, get back here into the 53.5 range, maybe it means that the timing's not right on the bear position. If we start to recover some of this prior support, but for now, down seems like the easier flow in Etsy. Talking broad market though, SPY sitting right at these highs, 53.30 right now. The high on the 26th was 573.30. Now it's 574.71. So we're about $1.50 away from a new high. Market flow, money flow is still on the bull side. Can that cause the breakout? We're retesting. We should find some resistance here. The support still looks like 565. So we've got a tight range for resistance and support between 565 and 575. I don't want to get hyper aggressive for the breakout until I start to see some movement just a little bit higher. I can miss out on $2 in SPY for the next potential run higher, just in case we do repeat more of like what we did here at the end of August and then get the pullback. That was for non-farm payrolls though, and we don't have non-farm payrolls imminent. Right now we just have earnings. We've got 3 weeks plus for non-farm payrolls. We've got an election coming up that could have some risk-off elements to it, but those risk-off elements I think are probably still a couple of weeks away. So we need something else to cause risk-off. We do have a lot of fundamental inputs to this market between the China pullback, the Middle East tensions, and Milton in particular that could cause some risk off. And if earnings starts coming poorly, that could cause some risk off. So just watching for what could cause that risk off that pulls us back towards 565 and then see if that holds. But right now, overall, I think we're in a very tight range, creating an inflection point, potentially creating a springboard out to the upside or back down to the 555 range. I'm not looking for a move here down to 540, barring a fundamental input that causes panic in the market. And right now, I just don't see that fundamental input causing panic to the market. Maybe if we saw major inflation, that would create a problem because right now we are lowering our expectations for rate cuts. And maybe we start to see inflation, so we really can't cut rates. And then that starts to create concerns that we can't fight against that next pullback in the market via lowering rates. Okay. So SPY, we are chilling near the highs. Let's see what that does. VIX, I always do the dollar sign, which is the bar chart version. but we're sitting right here at the highs on the VIX. That can often also lead to some risk reduction. So if I start to see the VIX fall, that actually may start to create some further upside in the election. We do have non-farm payrolls priced into that, and we do have earnings priced into that. I'm not sure I see a move back to 14 until some of this stuff starts to get resolved. So people are using options in order to define their risk and to hedge their positions. And that seems smart, but that means that these options are going to be more expensive, and I'm not going to get the same leverage as I would when the VIX is at 19 or 14. So keep that in mind as well. We do have a bigger risk here of buying options and then not moving. That would be the theta risk, I guess, and the vega risk would be buying options and seeing that implied volatility fall back to 19. What causes this VIX to go higher? Frankly, it's more concern and beginning of a break in the markets. So until we see a break in the markets, I don't expect to see the VIX pushing to 25 or 30, but for now, it is in a bit of a question mark spot. Okay. Tech is good, but not as good as the broad market. We know we're not at a new high. July is still a high. We did push above the August highs. We have not pushed above the September 26th highs. Semiconductors usually are my big indicator for if tech money flow is really strong, and we are a bit further away from the July highs. We have touched the August highs. We've not quite touched the September highs. I want to see some semiconductor money flow. And the biggest one, of course, being NVIDIA, looks really strong. Another up day today, another firm day. This just seems like it wants to keep trucking along. And I think when the market starts to get a little bit more excitement about this NVIDIA move, that may be it could create one of two things. It could be the short-term top where everybody is getting into semiconductors and then they have a reason to pull back, or it could create that oomph that we need, that tailwind that we need for the broad market to just push those new highs and get tech leadership back. But we'll just kind of see how it goes. For now, NVIDIA looks like a good strong long, using those in the money calls that we've discussed before. I think that was a really good way to execute the active trader philosophy. It adds the leverage to the upside while also giving some defined risk. So, again, if we look back here to the November 122s, I believe it was, from $9 now up to 16, we're looking at 80% return on this kind of move instead of 10% on the stock. So it's a very good leveraged way to utilize some of that capital. There is starting to get some interest already here on the 132 calls for November. Not any huge prints. There was a big print here on the Jan 145 calls. I want to see what that was to start the day. Looks like it was likely a buyer here that was trading above current market prices. So somebody came in quick and bought a few thousand of those right on the open. Maybe that's an indication here of some further bullishness on the medium-ish longer term here, 3-4 months out, with January options being bought. Earnings are not for over a month, so I don't have to worry about that too much on most of the positions that I look at, since I normally look at options expiring within the next 6 weeks when I'm making most of my trades. All right. And then finally, small caps. This is going to be, I think, biggest impacted by these financial earnings that are coming out early. As financial earnings come out, if they come out positive, that can give a little bit more of a tailwind to small caps and see if it can catch up. Because right now, it's just sitting and creating this great consolidation. That's a good setup from a technical perspective. It is setting up a nice springboard here. We can put in a couple of trend lines here. We tested a little bit below here in September. I can add another one here from just the shorter term pullback. You can see that we are really getting to that inflection point, and it's going to effectively meet right when we do earnings for JP Morgan and Wells Fargo. JP Morgan and Wells Fargo is our first banks. Of course, BlackRock and Bank of New York Mellon are also going to be important, but JP Morgan for financials to really consider here. And since I'm mentioning financials, I want to pull up Morgan Stanley. This was listed as an active trader idea for today. So I'm going to watch the action today, looking for something potentially near the close. As long as it's staying within a decent range here, the Nov 105 calls are the strategy that I'd be utilizing here. Yes, I do have earnings a week from today. So if I'm looking for a 1 week hold, a full 1 week hold and hold till the 16th, it means I'm going to be exposed to earnings. Earnings is normally about a 4% mover. So call it $5 right now, or $4.50. That would put the 105s out of the money. If we have a bearish earnings report, in money further. If we have a bullish earnings report, quickly put these full value from a $5.50, call it entry. As we know that, $4.50 would put this stock up to about 112.5. So it'd be a nice win if I held through earnings. I'm a little leery about the earnings elements here with the active trader ideas. So this is going to be one of those ones that I definitely just, I'm still paper trading this theory. Before I implement it in my account, I'll start implementing it in my account on some names. I hope by the end of this week. But for Morgan Stanley, that would be my first one that I'm looking at from a paper trade, looking through some earnings. So I want to have that really highlighted for myself. It's only going to be one example on the earnings, but every example matters. So starting that out, starting to get a better sense of it before I start allocating on the names that are going to have earnings exposure through the active trader idea of a 1 week holding period. Let's go over the precious metals. So gold, silver, understandably pulling back a bit after the China pullback. I think that for gold, my support looks right here around 240. So we're just above it. Silver is relatively weak. We are not seeing as strong of support here. There could be some here around these August highs. The 27.5 level really also pairs well with yesterday's low and today's current prices. So there's a question mark for me on whether to be buying into this pullback in silver in particular. It is a very, very defined risk, but if we get movement overnight and we wash out down towards 26.5, that could be painful. So it's a very questionable move today, down about 40 cents, retesting some of the lows from yesterday. If this can hold, maybe that gives me some short-term support, showing that this market is willing to buy around here. And since I mentioned China, we got to go there naturally. China is traded just below yesterday's lows for the large cap China stuff. We are looking at finding some support here. It's a very weak support. We didn't trade in this range for long. True technical support probably exists down around 30. That's pretty far down. I know it's only $2.50, but in an ETF like FXI, that can be a dangerous risk to sit there and try to find support down below 30. Looking a couple weeks out, the 30 puts are still only 50 cents. There's not a lot of premium in trying to sell a credit put spread or buying an in the money debit call spread with 30 as my support. So I'm still avoiding and watching a lot of the China names. And I always like to pull up JD because it was one of these big boys that really moved. We saw the implied volatility spike over 70. It's down to 65. It could easily get back towards 50 if we hang out and pull back. It is outperforming FXI right now in terms of the pullback here to the September range, but it's still down today below yesterday's low. Definitely seeing some profit taking here. But that's a good natural thing for the bull. It's also for the bear a question. How do I execute this on the bearish side? And the answer is I really don't. I'm going to look for implied volatility to rise again, probably not back to the highs if we start to recover. There was a massive drop in implied volatility yesterday. We can even look at, say, the Jan 45 con. Let's look at when last time we were right around $42. So we can look at the implied volatility hadn't really spiked there, but let's say the close on October 1st was 42.93. So just below, about a buck above here. So that was October 1st. And you can see how this chop can start to hit some of these options pretty well, because on October 1st, the options closed $4.50, a little bit higher, down about 20% with the stock only down $1 to where we're at right now. Yesterday's close was Yesterday's close was 465, so unchanged on the net with a 50-60 cent rally. This implied volatility is pretty crazy here. Absolutely looking at spreads until I can get a better sense on if this implied volatility is going to fall. I don't want to be over aggressive, hyper aggressive with buying outright premium. That is where that return on capital might look attractive if we can go back up to 48. And maybe we can. I mean, we certainly can. But is that too much too fast? I think the market is telling us that we did a lot of work here getting this 70 plus RSI. Getting it back below 70 is a good thing, I think, for the bull. It can start to get a little bit more rational bullish behavior. But again, debit spread, not looking for outright call options, or even using stock and just saying if there's a level here around this 39 to 40 range that gets pretty vulnerable, and it can happen today, it could happen tomorrow, but short-term trading when we get such big moves going on every day. All right. Let's go. I want to come back to Allegiant. Delta's earnings are tomorrow pre-open. So last earnings was bearish with a bounce back. We touched the 200-day and then started to recover, and then a few weeks later, really, non-farm payrolls pulled us all the way down to the lows. I think there's a question mark with airlines as well with Milton, but we're going to watch this for earnings. Right now, pricing in, well, we're still pricing in around the 3% move. We normally see a 3 to 4% move. I can see this being a bit more volatile than normal. To the lows on the July 11th earnings was a significantly bigger move because we had that recovery. It became much more in line with normal expectations. If we see a 6 or 7% move, call it to 55 on the upside, that could be interesting. That would be a new right above the highs, 54 or the previous highs. To the downside, 47 looks like a natural, 46.5 looks like a natural spot that could have some support here between this area around 45, 46, 47, something in there. My biggest concern with this is I don't see any big open interest magnet strikes here, particularly for this week's earnings. For next week, on the upside, there's not much. To the downside, we have a bunch of in-the-money calls that could potentially create a target on the bear side. But to the upside, I just don't see a natural target landing zone. So we've got a lot of earnings to go with. I don't see this as a slam dunk for me. I believe Vlad looked for 55 on the upside here for Butterfly. I think it's best to discuss with him where that where he's looking at this, as frankly I'm not seeing a ton on this one, but he may be seeing something that he likes out of this that I am just personally not seeing. So right now, airlines have been bullish. They're continuing bullish today. Maybe letting the Delta Airlines go first and then looking for a trade in United or American tomorrow can be a little bit better. We're seeing United basically making new highs here. Yesterday was the new high today, seeing a little bit of follow through. American Airlines has been generally strong here, testing a breakout from that resistance around $12, pushing above it now. Maybe that can start to fill this gap and catch up to the move we've seen. Love, a little bit different, of course, because they have a slightly different business model and they do have some other elements going on right now, but they are pressing these highs as well. We had the big breakout that really turned into a very small breakout on October 4th. We'll see if that follow through can come. I recall from years ago that they have a lot of potential risk, I think, with Florida. There was a flight that I was taking that I remember they had some issues with their planners, the people that were setting up where the airplanes were going on strike. This is probably 3 or 4 years ago. And when that happened, they were all out of Florida, and that southeast exposure can be a risk. Okay. So let's just keep that in mind as well as we go through what's going on with Milton. Allegiant getting a little smaller here, Bob. We're really testing that support level here. I don't know that this is going to be particularly impacted by the Delta earnings since it's a completely different business model. But if we start getting below the 55 level, I start to see some cause for concern. There's not a magnet per se on any of these option strikes. So it's still a trailing stop to me. If anything, there's going to be some resistance here around that 59 to 60 range, support here around 55. We're close to that support level. So I'd probably just continue with that trailing stop philosophy of knowing that if we get below 55, that this may be time to take the profits and enjoy the trade and say that was a good one. And it's been a good one so far. So congrats on that. I touched on gold and silver. I do also want to touch on oil. Oil is pulling back here. Seems like that move is being pulled back into the shop here. The range for USO seems to be really 72 to about 79. Now trading 74 after touching 79 and fading. So we really went right to these prior highs, which align with these lows. There was a natural resistance there, barring the fundamentals getting more uncertain there in the Middle East. Since right now, it doesn't seem like anything is escalating particularly crazily. We had a little bit of a pullback. And we've got to watch and see how this handles it for the OIHs, the XLEs, the ConocoPhillips, the Chevrons, the Devon Energies. All of the energy names are going to be impacted by this oil pullback. So just be very nimble, in my opinion, with the energy sector on the whole. CRWD, I actually hadn't looked at too much here, but it looks like it wants to go to 300. Really, 300 has kind of been that magnet, get a little bit above maybe to touch the 200 and the 100-day moving average, but it's down, up, down, up. It looks like a range trade to me right now. Support very much at 274. Resistance here $6 away. I mean, one could trade for a little bit of upside here, $6 to $10. One could trade for a downside of 20, or one could look at a debit call spread. If there's enough premium, is there enough premium in selling? There's just not much to buying like a 270, 275 for 420, but that seems like the safest debit call spread. If we like the idea of continuing to bank some higher highs on our dips, maybe 280 to 285 can create some support, and I could go to like a 277.5 to 282.5 call spread for 370 ish. Yeah, right around 370 for this call spread. And that could have a little bit of a return there, that 20% kind of return by just saying we don't liquidate CRWD in the next couple weeks. So and again, something to just watch for here. CRWD could be interesting with a debit call spread on an in the money call spread. So I do think that could be somewhat interesting there. Frontier, I haven't looked at, I don't remember the last time I looked at Frontier. Frontier is very strong here, you're right. We dip and then we spike. And now we're above the 200-day moving average. Trend followers really like this. We are seeing long-term bullishness. We're right at our strike for next week. All the open interest in this name is really for next week's $6 calls. That's going to, I think, create a magnet. If we can get to like 6.25 and start to follow through, then this can create a springboard effect. But for now, it looks more like a magnet than a springboard. With the implied volatility high, I got to wonder if it looks to me like the interest has been buying this, and the market makers must be short because they're trying to cover these at 100% implied volatility. So even though normally I would say this looks like a magnet, given that we're right there, this may end up just creating a lot of volatility in the next week, since we're seeing this elevated implied volatility, and clearly the market makers must be short to price this much premium into these options. So that could be an interesting point. I don't necessarily want to buy into any of these options, though, because they are priced priced for movement. This might just be a better stock trade. Looking for 10 to 15% in the stock potentially if this continues to go through. And we're seeing more buying right now as we talk. So let's watch that one carefully. But this looks like a stock trade. Maybe there's potential for Frontier to not be the buyer of something like Spirit, which has just been garbage, but rather somebody to come out and say they want to buy Frontier. And we do see oftentimes rumors of consolidation in these smaller carriers getting picked up when the opportunity presents. So I think that's something to watch here. But it's priced for a takeover. It's priced for a big move to the upside and the options. So I think it's a stock trade, not an options trade for me right now. But it looks pretty good using 5.5 range as my support and my stop level if we get below. And then looking for potentially 7, and if something crazy happens like a takeover, perhaps even more upside than that. Let's walk through the active trader ideas for today and how we're looking at that. We've got HD, and that's broken out and then pulling back. If it stays around here, let's see, well, the open was right at 420. What are these 415 calls? So those started the day around $18. If we see an opportunity, but we got to be careful, I think, with HD. If it continues to pull back into the range and negates this breakout, it would not be an entry. Lows as a derivative element of that is very similar on the chart. Active trader was on HD. Low may look a little bit better right here. So I think watching both of those could be very interesting for today, as long as the price action doesn't pull us back towards yesterday's close. So if we stay here in this range, in the breakout range, those could be an entry late in the day. So definitely ones to watch for today. Oracle had the bigger, tested the breakout yesterday and is sitting right at those highs. I actually like this a little bit better here. So going into the November 170 or 175 calls, I think could be really, really interesting for Oracle. Earnings not until December, so I don't have to worry about that input derailing this. We do have some good open interest at 180, so the 170 calls might be a little bit more interesting there. October 175 looks like it would be the magnet for next week. So way to execute that trade. That one still looks pretty good. Morgan Stanley, I've already touched on. PayPal. Five straight days of up, and it's breaking out here as well. So we are starting to see some breakouts to new highs here, and if the market continues to make a new high, this could really provide a nice tailwind. But this also looks pretty positive to me. The open at 80.90. How are those November 80 calls? 580 right now. Opened up around 530. So as long as we stay here, this looks like an entry. But if we get too much of a rally here and we get to 82 or 82 and a half, then we've probably picked up a little too much of the move already for me to chase into PayPal. It doesn't seem like a lot, but I'm trying to fine tune my entry points on a lot of these names. And with PayPal, it's getting to that point where I may be having to hold off if it continues bullish today as a trade that just didn't fit my system. All right. So right now, Oracle looks the most likely to be an execution over the rest. All right. SPY also looks pretty good. So I will note that SPY has been repeatedly on the bull side of the active trader. We've had multiple days in a row where SPY looks like an entry here. And as long as we stay in this range, I think today is another good day to potentially add. We had pretty big moves the October 7th and October 8th. So now that we're seeing that consolidation here right near the highs, it could be interesting. Leery of the upside, not necessarily getting that breakout. I'm going to look at this a little bit more throughout the day, but the other system that I've been evaluating and potentially testing out here is looking at slightly bullish calendars in names like this. So either a 574 or a 575 calendar. It performs really well with selling this Friday, saying we're not going to get the big move this week, and buying the following week. So if I go to like the 575s for next week versus the 575s for this week, that's about $2.30 right now. 460 versus a little less, 215. So that's right in that range of where I like to look at those calendars. So assuming we kind of hang in this range today, I'll look at that calendar here near the close as well. So, looking for a slightly out of the money call calendar in SPY, I think has some decent potential leverage here. And for me, just so you know, when I look at these calendars, they're not going to be a home run. I'm not going to make 100%. But if I can make 15, 20% in effectively 2 trading sessions, 48 hours, and then close it out, that's a pretty nice little return for my portfolio to compound that return. Okay, so I'll look for, I'm expecting I'll look for the 575 calendar because that looks like a better round number magnet for this Friday, barring some fundamental input that causes some sort of liquidation. But grinding higher trade, that can be a very powerful way to execute that for SPY. All right. Wow. Price target of 31 for ULCC. That's a very bullish price target there. Goodness, that would be quite a move if we got a price move to 31 here, 5x from the original price target of 24, raising it to 31, already very bullish, and then increasing it even more. So that is very interesting. For those that hadn't seen it, Bob just posted the Raymond James upgraded Frontier Group to market perform and adjust their price target to $31. That doesn't sound like market perform to me if you go from 6 to 31, but that seems like a very much outperform for me, unless there's no other. No, it is just ULCC. Okay. Well, he calls it market perform. I call it mega bull, given those price targets. But, I guess take that for what it's worth, right? We are seeing some more money flow into the AI-related names. Supermicro has the Department of Justice investigation, but when they started talking up AI orders, started performing well here. What's AI doing today? Up 60 cents. So, first one I go to because the stock symbol being AI, I think benefits them, makes them a very attractive name, kind of the first one that people think of. We may see some resistance here around 26, a buck away. But right now that seems like it's just got some good money flow. It's got some good interest. AI is definitely a buzzword that is still performing. It doesn't seem like it should be too impacted by the current fundamentals out there that are potentially derailing or changing the picture for oil names or anything Milton related. The other one that I have is half, and that is lagging a bit here. Really need to see it above this 100-day moving average and above that 13 level to see if it can start filling the gap in the next week or so, since my position does not have a lot of time to pay off there. How's uranium look today? Little pullback, but still consolidating near the highs. CCJ, little pullback, but still hanging near the highs. We saw a little bit of similar yesterday. We had the pullback, and then it started getting bought up. I'm in the 50-55 call spread, as I mentioned yesterday and multiple other times. There was a buyer of 5,000 of these November 55-60 call spreads yesterday. They're a little cheaper today. We'll see if he comes back in and buys again, or if he's now gotten to his full position. But that's certainly one to watch here is CCJ. Keep an eye on this 55-60 call spread. See if somebody continues to add to that. So they're using these little dips to continue to build that bullish bias, pushing for new highs. So I hope he's right, because it would max out the value of my 50-55 call spread if we can get to $57, $58, like it seems he is theorizing here. Oh yeah, PLTR did have a big move. Let's see how it looks today. Yeah, so consolidating near the highs today. It looks good. Earnings in a few weeks. Support is 38. Maybe 40 could be another, the previous high could be another support level to trade off of. 38 is probably too low. There's not enough premium there. So using that 40 level, I could look at like a 38-40 call spread. It's still $1.50, but getting into like a 38-40 call spread for $1.50 right now. Again, I'd be looking to exit around probably $1.75, $1.80. It's not a huge return, but it adds up. 10% here, 20% there, with high probability of success are the building blocks of a growing portfolio interest. We have very spread out open interest here in the October 25th, as well as the October 18th, more on the put side than the call. There is some open interest here on these 45s. So maybe we can get some follow through here, but I think I just look for a debit call spread and in the money debit call spread for PLTR given current technical setup. All right. Let's go do some of the earnings here because we know we've got Delta tomorrow, which I already touched on. Domino's also tomorrow pre-market. Their earnings normally about 6%. So that would be $25-ish. Support is just below that. We didn't do anything when we had no support last time. Dropped from 470 all the way down to 408. Is Domino's going to do something again like that? I don't know. There's not much open interest. It's a high dollar stock with a lot less option-based support here. Maybe at the 400 strike with 1,000 puts there, that could create some support to the market. But that's only $14. That's not enough to put my foot down and say, I love it. How about on the upside, 440? So that would be pretty in line with the normal move. Gosh, this just, going a little bit wide, like a 425, 440, that'd be about dollars credit. So about $2 and change to go to like a 4.25, 440, 455 call fly. Could be interesting if one wanted to trade DPZ for the bullish case. The downside, I'd probably look more at a put spread than a butterfly. I don't love it, but it's not bad on the call butterfly side. I'd love it if I had a clearer level to create a stall point on the downside in order to get that symmetric payout. But I think that there's something there to that 4.25, 440, 455 call fly. There's just nothing here for a magnet on the upside from the options world. It's just all about the technicals. And so nobody's really making a major positioning move, it looks like, for Domino's for earnings is basically what I'm seeing. All right. So why don't we switch to the banks? JP Morgan and Wells Fargo on Friday pre-market. This one has a little clearer support. JP Morgan in this 200 to 205 range. The normal earnings expectations about 3%, $6, 205. And then on the upside about 220. And for 220, if we get the bullish earnings, the 218 to 220 range looks like it's got some potential there on a technical basis. Our biggest open interest on the call side is 220, so that's a good sign. Biggest open interest on the downside, it's pretty spread here, just below 200, 197.5, 195s. So again, the call side looks a little bit more well-defined. Double the open interest on the 220s from the other strikes. Into next week, we do have 220s, look like a magnet again. The downside 200 and 195. So right in that range, that 200 to 195 range, and the 220 to 225 range on the upside. It would feel very precise, but I think a 215, 220, 25 call fly looks okay for 80 cents. To make it symmetrical-ish on the downside, I'd have to go to the 205, 200, 195. And that's going to be about 45, 60 more cents. So it's not a cheap double butterfly, but knowing that premium is going to suck in on Friday, since this is going to come out pre-market on Friday, means that this could be an interesting play, targeting either 220 or 200. The execution for me on that sort of thing would be tomorrow midday. So I'll continue to watch it for now, but I wanted to touch on it now since I'm not going to be back with you guys till tomorrow on the close. So 200 and 220 would be my targets for JP Morgan. Wells Fargo, on the other hand, earnings normally about 3%, and we sometimes get a bigger move, 6% last earnings cycle. 3% is not much. Puts us back here in the 55 range. To the upside, it puts us 59 range, which does make some sense on a technical basis. It's a very tight move to target either of those. Would be right between the big 56 and 54 strike on the put side. Call side is a little bit hairier. So I think that right now, JP Morgan probably looks like the best of the earnings plays, just given the overall setup. At least to me, that's probably the best of the earnings plays. All right. So looking for JP Morgan on the earnings side of things. A couple other names that I'm looking at right now. We'll do LMT first. So LMT and Raytheon hanging out here near the highs. If Lockheed Martin gets below 600, I start looking for 580. If it gets above 610, call it, I start looking for the upside. So we've got about $3 or $4 to the downside before a potential pullback. On the upside, we're a little bit further away. Trading it a little bit in the range seems okay to me, maybe just with a stock position or setting up a debit call spread with it expected to stay above 580. And not a ton of premium there on the 580. But, doing a 575.80 call spread for 890-ish and looking for like 9.5. So it's a pretty low return, limited return, but I think that's pretty limited risk right now. That's how I would probably look to buy that dip. Raytheon is hanging up on holding on here right at support. Maybe gets down to 122. So again, buying the dip with a debit call spread looks somewhat attractive here. Maybe a 117, 122 call spread. About 380, targeting 4.5. That might be a little bit better leverage than Lockheed Martin since it hasn't shown quite as much strength. All right. Last two that I had on my list. So I'm looking real close at Lululemon right now. We are playing around with resistance here at this 100-day moving average. We touched it and then we pulled back. We've touched it again yesterday and pulling back a little bit here. If I can get above, if I could start showing some bullish flow here that pushes us back towards 280, I start looking for this to go towards 300. Yeah, I mean, it's not a huge return trade, but 8%, 7% in the stock can generate some good returns in the options. If I look for like a November 280, 300 call spread for 680, trading at about 35% of the max value of that spread does not look too terribly unattractive to me. So I think that could be an interesting way to play Lulu. And then last one that I had was Chewy, because we all love our pets. And that looks like it is starting to get a little bit more. All right. So we've got support here at the 50-day moving average, bounced off of it yesterday, getting a little bit of follow through here. Up to 33 looks at an interesting way to play that. And again, I'd probably just look at this via a stock position right now, because even the November 30 calls, they could get 40 to 50% return if we go up to 33, but it's not a huge leveraged return. So this is probably more of a stock trade to me now, given the move we've already had today. Down here around 29.5, a little bit more interesting with the options, but with the move now, deleveraging a bit, it's more of a stock trade. If we go up a little higher, I can either look to play for that breakout if we can get above 33, and that's a ways away, 9%, or if we start to pull back, reevaluate a in the money debit call spread trading off of support at 28. Okay. So that's really what I've got for today on the stuff that I've been looking at. Is there anything else that people are particularly looking at, particularly interested in for today's trading? We are seeing SPY hanging in there, SMCI hanging in there, semiconductors doing just fine. Getting a little bit more catch up there in the AI names with Path and AI getting follow through. That's nice to see for me. Oh, the Bitcoin trade. Yeah, let me pull up Bitcoin. So it looked really bullish again and then pulled back again. Just a couple days ago, we were starting to see that move higher. It looked like it wanted to get up to the 66 range, but pulled back instead. You can see that we're just kind of towing along the support line here, tightening up this range more and more here. Higher lows, lower highs. Let's see if we can resolve that. If we get below the 61.5 level, the Bitcoin names are likely to get hit pretty hard here. We're holding on okay in Riot. We're hanging on okay in Mara. The downside, we're not playing too close to the downside, so that is a generally good sign. Coinbase still may be the one of greatest interest here, targeting that $200 price point over time. We're going to have earnings before it could I expect to have earnings before getting to 200, but if I'm willing to take some risk here and hold through earnings in November, 180, 200 call spread still looks somewhat attractive here at $5.50. Okay. Oh yeah, double back to NVIDIA here. So NVIDIA is certainly the first one I pull up when I think of semiconductors. I think that's pretty common. As long as we can hang here near the highs, I still think this has some good hold to it. We're not showing any real signs of major risk off in NVIDIA in particular. There's a lot of semiconductors to evaluate here. I think NVIDIA looks fairly strong here. And just using a trailing stop, we're still making higher highs and higher lows. The money flow still seems positive. Maybe a Micron if NVIDIA starts to explode. Looking back at Micron for a long entry to retest the earnings day highs, 115. That could be an interesting strategy as well for me. So I'm not in NVIDIA right now. Just on paper, watching that one from the active trader entry last week. And for personal execution, I'm going to just look for, if that continues higher, I go back to my little devil here in Micron, but forget about what happened, a couple months ago and start focusing on what's happening now in Micron or AMD. And I think that those could be benefactors, but I think Micron for me is probably the most interesting of the crew. So Ted, I do sometimes look at the straddles on earnings. The biggest issue I've got with earnings straddles is, if we've got a situation where I'm betting on movement and I get something like what we had in AMD in November of 22 or January of 24, I can lose that premium real fast. I don't like selling straddles because that's selling two naked options, not just one. And if we get something like what we had in, Ford, where we go 18%, I can wipe out a whole account. So if I think that we're going to stay range bound on earnings because the market's just pricing in too much, Then I looked for an iron condor, selling a put spread and selling a call spread. If I'm looking at the market pricing in too little, I tend to prefer trying to see if I can target my strikes. I can go with a simple iron condor if I think we could just not have natural resistance or support. It's going to cap my upside, but when we've got an opportunity, got to take what I can get out of it so that I don't waste away all the premium, because, we look at Ford, we had a 0.69% move and an 18% move. I'm adding in a lot more dispersion to my potential returns there when I see that potential for a full wipeout or a massive return. So oftentimes that straddle is just, it's a high risk trade. So I have to be able to do it for a lower amount of capital. So like a Ford where it's $10.50 might be more interesting than trying to buy a straddle in like Domino's Pizza at $400 a share. The at the money straddle here, if I was going to bet on higher movement, it's over $30. So pricing in $30 a movement, I'm going to pay $3,000 to trade one contract. So I always look for a little bit more interesting, fine-tuned. So maybe a little bit lower or a higher return on capital, maybe a little lower probability of success there. But if I can see a good structure that can really provide me a strong magnet price point, I like that a lot more, because I can do a couple of extra layers of depth into my my analysis. Yeah, I looked at MELI this morning, and it's that same problem of being a $2,000 stock. It becomes inaccessible to a lot of people, but it does look like this support at the 50-day moving average and in this 1960 range is holding. So now $90 of upside with 75 of downside. Now it's a good looking trade overall, but it's an expensive trade. Even with the call spreads, if I wanted to say that like 1960 was going to hold as support, in order to get any real premium here, I have to really start to widen this out and increase my risk. So like a 1920, 1960 call spread, call vertical is trading at, oh gosh, what is the put spread? The put spread is $14, so like 26. And there could be some leverage there still, but I got to hold it through for a little bit of time. That's going to have earnings. If I want to avoid the earnings, I just don't get that much premium here on a similar 1920, 1960 call spread. It's still $32. And I think that's the safer play in MELI right now, or that's the trade that I would see in MELI, is looking more at a debit call vertical and in the money. It's going to cost a lot of money though, right? So eBay, come back to her. Still grinding higher. I've liked eBay. I think that came out with a long signal as well a couple of days ago again. And, just riding that trend can be a decent strategy here. Earnings look to be early November, with both the 8th and the 15th being bid up a bit here. Market looks like it's pricing it in, coming in before the 8th. But riding like an in the money call for a week or two, even though it has that earnings premium, that should hold up, because earnings is going to continually be priced into that. And then EAT. Brinker. Oh, Chili's. Okay. Last time I went to Chili's, they weren't the best, but support around 80. No weeklies, limited liquidity in the options, so it's okay for options. You can see like right now, most of these options are 30 to 60 cents wide on the at the money options, or the slightly in the money call options. I'd have to see the 82 and a half tighten up to get a better execution, but it does not look terrible. Could consolidate for a few. It's not a ton of premium on the put side. Maybe a simple 82.5, 85 call spread. It doesn't sound like a lot, but at $1.30, I only really need 20 cents of upside to start getting some appreciation there. It's not trading for a ton, about half the value of the spread, half the max value. So on a general slight bullish buy, a little bit of a bullish bias here, looking for it to continue that trend higher. That might be a way to kind of balance getting a little bit of leverage with also still defining the risk somewhat here. But if it gets down here in this $80 range and can't hold, that's not a good sign for it. So 82.5, 85 call spread, still looks reasonably attractive as long as we don't see something derail the whole market that pulls down EAT. And I don't know that I see a fundamental input that's going to derail EAT outside of like if somebody came in with just a big stock downgrade for it. So could be on the tired side. I still know that there's enough. I suppose I could look to sell an 85, 87.5 call spread. Again, I'm not looking for this to explode higher right now. 85 could provide some resistance, which is part of why I was thinking maybe that 82.5, 85 call spread on the long side. If I wanted to sell a call spread against instead, selling the 85, 87.5 call spread for 90 cents in small size is not too bad. Risking $1.60 to make 90 as long as we don't make any lie. So that's kind of the strategy for me on that, I think, is looking for range bound, and maybe it's selling that 85, 87.5 call spread. And then if we do dip, starting to look to sell a put spread against it or just covering that and taking that. I don't see a big reason for us to go below 80. 82 should provide some support here in order to justify the bull. If it doesn't, then selling like an 80, 77.5 put spread could be interesting into the dip. So here for the bull, maybe looking for that test of 85 for the player looking for it to be a little tired, just accepting that 85 right now is going to be resistance until the market tells us otherwise. So if people start to accumulate more, maybe we can pop above it. But yeah, like an 85, 87.5 for next week. If I think that we're tired and we're not going to go higher in the next 9 days, the next 7 trading sessions, 8 trading sessions, that could be a way to execute that sort of strategy. All right. All right, folks. Bumping against it. If there's any last stocks you like, let me know. If not, I will be back on tomorrow for the close and we can talk through some more market ideas. I think to summarize on the earnings, JP Morgan, butterflies targeting 200 and 220 look the most interesting for the earnings coming up into the end of this week. I like the idea of Oracle. And I like the idea of SPY call side calendars, like a 575 call calendar, buying next Friday, the 18th, selling this Friday, the 11th, and closing it near the end of the day on Friday. But I'm looking at these things being end of day trades for me. So more monitoring and evaluating new ideas throughout the day. And then in maybe 4 hours, looking to see if they still line up well enough for me to execute. All right. PLTR. Let's see the big options trades for today. Side. There's no 37 put. Looks like it's being sold today. So there's some selling action here on the November 37 put, which makes some sense. With this support here around 38. Here, I mean, those 37 puts will decay some, but with earnings priced before that, I don't like to get too aggressive with selling November puts here. I still think something, here, the October 25th 40 puts. Has that been a seller as well? Yeah, so there's been a seller here of the 40 puts for October 25th. or a few sellers here, a little chunks, 85, 75, 70, just hitting the bid there. Overall, implied volatility is up, so there are buyers likely of calls here. So it looks like we kind of have call side buyers, put side sellers. So financing the leverage breakout by playing that we won't break through support here around 38 to 39 range. So a little bit of both today is, I guess, my answer. We do have some call buyers, but we do more call buyers than put sellers with the breakout today. I did want to touch on the skew index, speaking of which, for the overall market action on it. So the skew index is coming down today, which means to me that people are not aggressively buying puts in the market. They're selling puts relative to the at-the-money volatility. So skew right now looks like people that are trying to protect are probably buying put spreads or buying calls for the breakout. All right, so the skew index looks a little bit more in line with that as well, saying limited downside and potential for some upside. The skew index here showed puts coming up a little bit relative to calls. And like I had mentioned, the VIX sitting near the highs here, pulling back slightly, but not as much as SDEX. So it looks like the idea here is that people are buying some put spreads in the market to hedge their position, maybe even going full around there to sell some calls and buy some put spreads. So selling into rallies that way and reducing risk on the downside. So there's some hedging activity today, it seems like, for sure, for the broad market, that is. Excuse me. All right, folks. We're right at 10:30. I hope you all have a good trading day. Stay safe. For those of you like Bob down in Florida, I hope everything goes really as best as it possibly can. I know it's not going to be good, but hopefully it's not as bad as some of these models out there are predicting for people. So stay safe, and I hope all goes well for you guys today. Thanks again, everybody. I'll talk to you tomorrow at the close.